Thank you very much, everyone, for participating. I'll just do a quick introduction because we don't have too long for the overall panel. Biographies, of course, are available online and in the brochure. We have Charles Bond from Gowling, who's going to be anchoring this one. David Street from Tembo Capital. Ignacio de Calonje at IFC. Juan Alvarez at Nebari Capital. Miranda Westiruk at OCIM. And Justin Machin from Denham Capital. Thanks for giving your time to provide some insights here. So over to you. Thank you, Charles.
Thanks, Adam, and thank you everyone for making it back after lunch. We might get a few more people wandering in after coffee, but this is usually quite a popular time or certain program to deal with, because I think mining finance is back in, hopefully coming back into full steam at the moment in the current market. So we've got some real experts here on the panel. I'm going to ask some questions. If people do have questions from the floor they want to throw out as we go through, please don't be afraid to get up and ask. We'll stick relatively to the program. The first question I think we've got is around the fact that obviously we are in a good market at the moment, so much different from when we've done this in some previous years, and metal prices have been fairly much sustained. So for the financing community at the moment, the first question I think is, what's on your mind at the moment? What are your current selection criteria for miners? Which mines do you want to finance? So I'm going to just start to my left immediately. And if you want to make a first move on that one.
Yeah, absolutely. So, I think there's a lot of competition for the good assets, and very important for us at Nebari is to do a deep dive in terms of the technical due diligence and the legal due diligence, to make sure that we weed out any potential problems or red flags. And we look at, pretty much kind of everything on the technical side. So we have a geologist in-house, we have a metallurgist in-house, and and an engineer in-house. And we're kind of looking at things from different perspectives, to try to make sure that we're on top of where those fatal flaws can be.
David?
Yeah, can you hear me?
Yeah.
Look, I think like many other people, we're looking for high quality assets. We're looking for assets with grade. We're looking for assets that have sufficient scale or potential to scale. Tembo, we've just raised a new fund globally, and we're looking to sort of take strategic equity type positions in companies. So if that's the entry point, the exit point typically is being bought by a bigger company or getting the asset into production. So we're looking at things that have appropriate capital intensity, that a small company could hopefully finance it into production, or it's going to grow to be bigger and to be interesting to a bigger company. So we're trying to be in the bottom part of the cost curve like everyone else. Fairly mainstream commodities we're interested in: base metals, gold, precious metals generally, one or two other selected metals. But we're really asset quality, I think, is the main thing, and then ideally helping to build the right team around those sorts of quality assets.
Ignacio, I know you probably get quite a lot of approaches at the IFC. How do you pick and choose and filter those out?
Yeah. So, I mean, we do both debt and equity, but here I'll talk about the equity part. I think on the juniors, we've become much more selective on juniors. We used to do a fair amount of junior company investments, and we've become much more selective. And I think as a minority partner, we always are minority partners, typically up to 20% stake. We obviously look at the quality of the assets, and as everybody else does, but we are also look very carefully at who our partners are, who are the co-investors are. For us, that's been a key determinant to ensure that there are deep pockets behind the company, that there are knowledgeable co-investors, that when the inevitable down cycle comes, there will be the patience and the perseverance to see the company through that down cycle. And so I think that would be one key sort of element that we look at, in addition, obviously, to the management team. So again, being a minority partner, unlike a majority shareholder, we can't simply change a management easily. So we're very often stuck with the management. And if it's a great management, that's great to be stuck with them. If it's not a good management, that's less great. So.
You mentioned, just because I get the panel is beyond equity, so I ought to ask you about the debt side as well. Are you? Can you fill us in on the debt as well?
Yeah, I mean, I'll come to the debt later in terms of how we're looking at it, but yeah, so lots happening on the debt side as well.
So as you can see, OCIM is essentially a short-term investor. We prepay to producers or near-term producers for access to their commodity. The core business of OCIM is a metals trading business. So for us, we're involved for 12 to 18 months, and then we can revolve the funding. But really, from our perspective, is to look at the operational expertise, because we are coming in at the production stage. So we really need to understand, can the management team continue to function? We do a technical due diligence. We bring in expertise from our Toronto office. We're hiring a mining director now. And so we really need to understand, can this entity deliver to us a specific number of ounces of gold over a finite amount of time? So really, management, we work across most jurisdictions. We assess obviously on a case-by-case basis, but really we're focused on that 12 to 18-month timeline.
And Denham is an active, hands-on private equity investor. We focus on assets that are later in the stage of development. We typically like to be last money in to help fund construction. Our portfolio is quite diverse. We've got precious metals, base metals, industrial minerals, bulk minerals. And I think in this current market environment where everybody is focused on energy transition, valuations are quite frothy. We pride ourselves on being able to find value and to look at things that are a little bit off the beaten path. And so that's where we've been focusing a lot of our time.
Let's just maybe just out of turn, but focus a little bit on that when you say things are very competitive. One of the things I'm seeing a lot in the market is kind of packaged finance products now, where a number of you are coming together to if it's a large financing, maybe it's $500 million or $1 billion. No one person can bite off all of that at one point. So how do companies put that together with you guys, or do you go to companies with an idea and maybe how to package it with someone else? How competitive, or is it, do you all work together? I don't know if anyone wants to pick that up.
Sure. It's actually quite interesting. I think more and more, and David touched on this in his focus on scale. We've found that with our fund size, the best way to get assets with scale is actually to partner with our peers. And so we're in a deal with Orion. We've done a deal with another sponsor. We're actually looking at another deal right now with a sponsor. And so pooling our resources, focusing on different parts of the capital structure, we found that we can work together to take on some bigger assets that are higher quality.
I was going to add, our sort of main ticket size is 1 to 20 million that we look to deploy. So partnerships is very much something that we are keen to explore, so we can find synergies with other lenders if there can be equity bolted in. But definitely from our perspective, we are actively looking and working with partners to put a good solid funding package together that's creative.
Yeah.
Yeah, well, I'm going to be boring because I'm going to agree. No, look, I think, and it goes back to the previous point I made about who your partners are in a financing, and I think it's key. Whether it's sometimes some of us have blind spots here and there. I think we obviously can bring on the ENS perspective and some of the broader sort of political perspective, and there are other partners that provide other attributes. So we actually love to partner. We typically, for our own account, can't take more than 25% of the project. So actually, we have to partner with others, and if there are different instruments, our preferred option is to actually align across the instruments, so that we don't have any squabble in terms of alignment of interest. But sometimes that's possible, sometimes it isn't. And we've worked with people like Appian and others along those lines.
And does it tend to be the company that takes the initiative in trying to put these packages together, or is it normally yourselves or brokers who'll come to you with the idea?
I think really varies depending on the company. An example, at the moment, we're working on something may or may not happen, but we probably could have just about done the whole deal ourselves, but we felt it was better to partner with another group because this company's probably going to need a number of rounds of funding. So being aligned with someone like that, as I think you raised the point about deep pockets, which is a good one, making sure that the sponsor group is has sufficient funding to see it right the way through is really important.
Yeah, from a Nebari perspective, I mean, we're primarily a debt fund, but we're small enough and nimble enough to be able to look at different types of funding, but not necessarily our core funding. So we often listen to, the package that the counterparty wants to see and then try to tailor something for them and pull in partners that we know that can, provide parts of that capital stack that, we're not the experts in and try to team up in that way.
It's
so
interesting.
It's more driven by us.
I mean, just looking at the panel, apart from the IFC, none of you are what I would call a regular bank. There's no Societe Generale here or one of those guys. So has that market gone? Is it still there? Or where are you seeing a lot of the big banks still in the market for debt financing?
Well, I think there's a lot less of the big banks, as you can see. The space has grown, in the last, I don't know, let's say 10, 15 years, where alternative finance now it's not so alternative anymore. It's really quite mainstream, like the streamers and royalty funders, the PE guys, high net worths are coming into the space as well. So there's definitely the breadth of providers has grown from what I've seen quite a lot over the last 10 years.
Yeah, I would say, I say that would be particularly the case for junior greenfield financing. Commercial banks are obviously extremely active in the sort of corporate lending world, or very traditional sort of project financing with a big sponsor, a completion guarantee, and these types of things. Where I think they've retreated quite a lot is obviously in that sort of mid-tier junior, the sort of 200 to whatever, $500, $600 million greenfield project. I think that's where, without a sort of a major sponsor, that's where I think the commercial banks are much less present than they were. And that's where the alternative finance world, with that sort of package solution across the capital structure, has frankly stepped in and provided a solution.
And I think we've seen that bank financing is more readily available if you're doing something in gold or in copper. But if you're doing something a little bit more exotic, like rare earths or tin, you find yourself getting a much warmer reception with the alternative lenders and streaming companies.
Yeah, understood. Okay, I'm going to move to the next topic now, which is the hopefully quite a popular topic, which is the decarbonisation topic, with climate goals and COP just having happened. How is this impacting on how you're looking at investments? I'm sure it was already there beforehand. It's maybe just more highlighted than it is now at the moment. But for juniors coming to look to borrow money from you, what have they got to do now to impress you on their climate goals, etc., and zero carbon?
Well, I can start. I actually sat in on a panel yesterday, which was sort of a debrief on COP26, and really the whole idea of green financing, and they had a manufacturing company, a metals and mining company, and sort of the commentary around ESG and what we need to do. And really, it was no project in any sector really, unless you have started at zero. Looking at environmental, social, stakeholder, community, all those issues, those projects generally won't succeed, right? So from OCIM's perspective, because we're looking at, a small block of capital that is short term, we really need to understand what exactly is going on the ground, right? We send our teams in with environmental, social, what's the culture on the work site, right? Because if those aren't working, then the operation won't work.
Well, I think from IFC's perspective, we created the performance standard for the equator principles over 20 years ago, so it's been core to our sort of way of looking at things. I think more recently with whether it's been Paris or COP26, we're just ratcheting things up, right? So we've already committed that by 2025, all our investments across all the sectors will be Paris aligned. So it will be 85% by 2023 and 100% by 2025. And likewise, most of the multilateral development banks have also made commitments. What that means is that every project that we look at will have to be screened to make sure that it was consistent with the Paris Agreement and the 1.5 degree scenario. What that means for mining more specifically is that it's going to be increasingly hard to do mines that are for example, entirely reliant on thermal and not doing a proper alternatives assessment to see when that thermal can be weaned off, etc. So there may be situations where you have no other options, but that is rarer and rarer. And so if it's a mine that is not considering renewables and storage as part of its energy mix, that's going to be problematic for us. And we want to have those discussions up front with that company to see why they're not considering those options. And again, it might not always be possible, but they should at least be very thoroughly investigating those options.
Look, I think as finance providers, we have a really heavy responsibility as well, and we can be part of the solution as well, right? Like, so as a lender, we can lend to companies to meet or to help meet an ESG criteria or something where that those funds are ring fenced to help the miner improve, right? And we can look at that that perspective and say, we want to help rather than just put the burden on the company.
And I think to Juan's point, where we're typically investing as later stage businesses that have proven themselves and done good stakeholder engagement and have been responsible operators in their jurisdiction as they gear up to complete permitting or to move to construction. However, we work with our portfolio companies to help them augment their ESG practices. With a couple of our businesses in the Americas, we're actually moving towards being IFC performance standards compliant. Which I think it's the third standard, which is resource efficiency, which talks about reducing greenhouse gas emissions. So it's something we're really focused on, and ultimately, it's for us, it's the right thing to do, but it also helps us to position our businesses for exit because this is increasingly coming into focus for public companies, and I think it's going to be a big part of their M&A acquisition criteria in the future.
Yeah. I think this is actually a really big opportunity for the mining sector. I think we've just been and raised a new fund to invest it across different mining metals projects. This was probably the number one question we had from investors who invested with us. Those investors typically look at sort of real assets as a category, which traditionally has been oil and gas, mining, property, real estate. They're obviously whittling down their exposure to oil and gas. Typically, I think this is a real opportunity for the mining sector to position itself to provide those materials for the decarbonised world. And some of the numbers you see on demand requirements for lithium, manganese, copper across the spectrum really are huge. But the challenge for mining companies and the mining sector is not very good at selling itself on this. I think a lot of this work actually is done very well within the mining sector, but I don't think it's publicized or promoted terribly well within the sector. But I think it's a great opportunity to convince people that these metals are absolutely required and that they're being mined in the most ethical and efficient and environmentally responsible way. I think it's a way in which the sector can open itself up to receive a lot more capital over the next few years if those things are taken seriously.
Yeah, that was one of the questions I had. Is people often say that mine finance is, when you look at it, the kind of global pool of debt capital available. Mining is actually only a very small piece of that. If people are performing to the relevant ESG standards, etc., is that going to open the door to wider global finance, green bonds, etc.? Will some of that money be available for mines, or is that too much to wish for?
I mean, it's early days, but I think it will. I think some of those initiatives will come through. Yeah.
Well, I agree that the Bank of Montreal just closed a loan with Tech, a $4 billion loan that was a sustainability linked loan with very specific KPIs around reduction of greenhouse gas emissions, gender and diversity in the workforce, and sort of broader sustainability issues on their sites, which was very interesting. And the bank has committed $300 billion to 2025 for these sustainable loans, these green loans, which is a huge amount of money. And I mean, we're rolling into 2022, so in the next 3 years, we're going to look to deploy massive amounts of capital into this sector.
I think one thing that we saw that was really interesting, rare earths is a space that's really kind of near and dear to our hearts. We have a big project we're building in Brazil, but MP Materials is a listed producer of rare earths out of the US. They recently did a green convertible bond. They raised $600 million, was massively oversubscribed. The pricing came in at a 0.25% coupon, and there was a 26% conversion premium, which is, incredibly attractive capital. And they're to use those proceeds for green initiatives within the company. So that was really interesting to see.
Yeah, I think that the point is it's important to get these finance on these labeled products, right? The green sustainability linked, because I think investors won't necessarily go through a long sustainability report and sort of go through all the ESG standards and all the rest. So I think these green sustainability linked social type of loans and bonds allow a very clear communication to the investor community about what they're doing. And particularly, we're quite excited on the sustainability linked side. We're actually in discussions and sort of doing a deal with a very large mining company, a sustainability linked financing where the KPIs are actually social KPIs. We're also mandated for another project in the lithium space, which again is going to be a green loan. So I think these labelled products are great, and I'm actually responsible for stable finance for the broader infrastructure group at IFC, and we're seeing an explosion of demand for these types of products from both the investor side as well as on the company side. So it is an exciting moment, and I think it's said. I think the mining industry is actually well positioned if we're able to articulate the story around critical minerals to really capitalize on that.
Yeah, and talking about which minerals will win in those types of scenario, are there any that are more likely to attract that sustainable finance than others? Or, I mean, coal is obviously the loser, but who's the winner? Or are there a number of them? Lithium, you've mentioned, is clearly one.
Yeah, so obviously lithium and we've got actually the World Bank published a study about the role of critical minerals for the energy transition, and actually we have an initiative with the World Bank called Climate Smart Mining, which is to sort of map the net zero pathway of the whole mining sector and different sort of commodities. And we're focusing, I think, on nickel first, and then copper. So look, I think it's pretty well known which commodities are going to be taking off in terms of demand growth. But I think there's a broader point, which is yes, it's important what the commodity is. I think the other thing is how do the companies sort of integrate ESG and sustainability into their overall strategy? And we've been focusing a lot also on some of the majors and some of the mid tiers, how what they're doing there, and I think they've been doing a fantastic job. Some of the mid tiers, at least, and majors in terms of net zero commitments, in terms of very tangible commitments to reduction of GHG emissions or others. And I think that's also something we're focusing, not only what commodities are they producing, but actually what are they doing in their operations to, whether it's save water, reduce GHG emissions. And those are going to be the winners, the ones that are at the forefront and have a credible sort of plan, which is not always the case.
Yeah, there's a few groups starting to do sort of benchmarking studies of GHG emissions by asset across different sectors. Wood Mackenzie's done some work on it, for example. and one of the companies we have invested in, Marimaca Copper, has sort of engaged with that. I think it's particularly important from the point of view of some of these companies growing, developing their assets. The big companies are really going to focus on those ones down the bottom end of the GHG curve, if that's the analogy, because they want to move their business in that direction. So if you're trying to develop assets which will be attractive in the long run to major companies, you need to be the right end of the curve, I think.
And from a commodities perspective, I think, outside of coal, which you mentioned, it seems to be open to any kind of manner of metals producer. Certainly, we just saw Newmont did a sustainability-linked credit facility, $3 billion. And so I think, even gold, which doesn't really have a energy transition or battery metals type theme, Newmont was still able to attract that kind of capital.
And it's interesting what you said, Juan, about kind of feeling a responsibility. I mean, once you've put your money into these companies and you've given them a whole load of covenants, obviously, to adhere to, presumably there is a responsibility for you to make sure that they do meet those ESG targets, et cetera. And how do you kind of regularly monitor that? Are you pretty hands-on when it comes to that sort of operation?
Yeah, I mean, we have kind of like a multi-track. So obviously, at the very first stages, you do your due diligence on their ESG credentials. You also want to make sure that, contractually there are things inside those. Let's say there's the debt contract, which are real, that have some teeth, so that if they don't meet those targets, there are ramifications. And also, back to that responsibility point, we want to help. So if they're falling short, we want to provide advice or provide capital to help them along, or not just the monitoring, but the actual assistance part of it, I think, is really important.
We work in a similar way, in that in our agreements we make sure there's specific covenants and reporting requirements that we need to see, and we set up a very specific reporting schedule post deployment of capital to not just monitor, but to work with the companies to keep the project moving forward and evolving. And if they need help, how can we help?
Yeah, I think from our perspective, so I would say the last 15, 20 years has been one focus on compliance. So we had all the systems, do very regular monitoring, et cetera, to make sure they meet our minimum compliance, which are always typically above national compliance levels, but still compliance. I think what's exciting now is, obviously that still remains, but what we're trying to do is go, how can you do better? How can you actually be at the forefront? So, right, you've got thermal power, right? Well, let's see, can we help you with a study to look at integrating renewables and storage? Now, it's not maybe mandatory, but it would be great. How can we help you with a pilot project to integrate hydrogen into and test hydrogen into your operations, or other types of initiatives? So I think we're at the stage now that we're saying, obviously compliance is great, but how can we help you go that step further? Because at the end of the day, what's going to count for those investors is going to be not only meeting the bare minimum, that you're actually ambitious and ahead of the curve. And I think that's where we're trying to sort of deploy actually funds. So we do have some funds to help in scoping studies, pre-feasibility studies for new technologies that we apply to our clients when we invest.
And does that mean also that when you're looking at an investment now, maybe some of the old skills are just as important, but now you're boards, for example, you're looking for people with real ESG criteria, people who've been in that industry. Well, it's not that old, I guess, but people who really know what they're talking about on boards. Is that a kind of fundamental, or are you happy to kind of teach an old dog new tricks, so to speak?
Well, it's all about attitude, right? So it's is the management committed, and do they see the opportunity, or are they the defensive type just trying to cover their behinds? So if it's the defensive type, that's not great, because they sort of do it reluctantly because they feel they have to. What we're looking at is the type of management teams that actually see the opportunity to capitalize on this and see the value accretion from actually doing it as well. That's what we're focusing on, attitude, not so much. I mean, skills, you can get skills from anywhere. It's the attitude.
That's right. It's the culture, isn't it, across the organisation, and it's actually a great opportunity for companies to distinguish themselves with investors. I think if people do take it seriously and are progressing in the right way.
Yeah, I would just add that there is greenwashing that goes on, but I'd say it's actually surprisingly easy to in the DD process to kind of scratch the surface and see through the greenwashing. So if companies are thinking, oh, we can just like get the policy in place but not actually do anything about it, it's not hard to figure that out.
And is it this kind of approach leading to any kind of novel or trending new forms of finance? I mean, we touched on the bonds and the sustainability. Is there anything else you're seeing that's kind of new to the market at the moment in that area?
Well, it's broadly related to mining. I think one key issue that we're dealing now, and it's broader in this sort of infrastructure space, is coal phase out. And so how can we encourage the phasing out of coal? And the Asian Development Bank has got a vehicle to sort of see how they can take coal, in this case, coal power plants, but it could also apply to coal mines, how they can actually spin that off and actually create a vehicle to then wind down those mines, including some concessional funding. So there has to be some sort of blended finance or concessional fund to sort of provide the investors a motivation to wind those assets down. So that type of vehicle and financing is definitely being thought of by a number of people to tackle the most difficult sectors such as coal.
I think one of the kind of interesting alternative financing solutions I've seen recently is carbon streaming. So businesses that are able to qualify for carbon credits can stream them off to raise capital, either to fund those projects or to fund other projects within the business.
Is the carbon offset as well, or is that kind of a bit old school now? Buying forests in Scotland.
People are doing that as well. Yeah.
Yeah, I think half of Scotland's under some sort of foreign ownership now. Okay, well, we'll move on a bit. I guess the other questions I wanted to just get back to kind of regular financing, and the forms of finance that are trending at the moment. I guess 3 or 4 years ago, I would have stood here and say we'll be talking about royalties and streaming, but they have become fairly standard in the market, although I think streaming is still not quite made its way fully to the UK yet. I think it's more still a Canadian invention to some extent. Which forms of finance, I mean, you will obviously represent different types, but do you think is going to, for this coming year, is going to be the kind of main form of finance, or is it all going to, everyone going to be in the same boat, do you think?
Well, that's an interesting question. I think companies, they, and I think a number of the panelists have said, they come to us with specifics in mind. We'd like to have X amount of dollars. How can you help us with that funding? And can it be creative? Can it be nimble? Can there be partnerships? Can you work with other groups? Is it okay if we bring some equity in? We like the prepayment idea because it's short term, but maybe we can look at longer term, royalty or streaming. But how can we build the best suited package for what we need the funding for, really? So I don't think I can really pinpoint that this is going to be, Q1 next year is going to be the star, but I think it really depends on the company and what they need and what kind of capital they're wanting to use. A number of the companies I've met over the last months are quite, they don't want to dilute their cap tables at this point, so they really are looking at non-dilutive forms of financing. Is what I would say.
Do you think the amount of funding available is going to grow, given it's a buoyant market, or is it still going to be very much fact specific?
On the equity
and on the debt.
On the debt, I think as there's more creative debt out there, I think it is going to grow because companies are looking for those kind of solutions. If they can understand how to manage it and manage it appropriately, then I think there is opportunity there for that.
what we've been seeing, and it's actually been really helpful for what we try to do, is there seems to be a fair bit of debt available across the space, but equity is in short supply. So that's opened up kind of great opportunities for us. And additionally, we've seen this more in the private markets. You don't see it often in public companies in the mining space, but preferred shares are starting to be used in capital structures as kind of that mezz piece of financing, just given the lack of equity.
And does that go hand in hand with things like convertible loans as well then?
Yep. We've done convertible prefs as well. So
yeah.
Yeah, Nebari has a convertible offering as well, and it's something where we've really developed over the last kind of 12 months or so. And it's really a form of financing that is gaining traction. Certainly from what I've seen, because it kind of bridges between straight debt and straight equity. It's
and often
like
doesn't
quasi
include security as well. Depends, I guess.
It really depends. I mean, for Nebari, we would still need senior security,
right?
But it allows a company who believes in the upside of their share price to take lower coupons and lower returns thresholds in return for some of the upside on their equity. So it's kind of a real quasi
debt instrument. Yeah.
We did quite an interesting deal last year where the company, very small company, needed quite a significant amount of money relative to the market capitalization of the company to buy all sorts of pieces of property, really, to make the project or put the project together and consolidate it. So we did an equity position, but not one which overwhelmed the existing shareholders, about 30%. We bought a very small royalty on the property, and we did a convertible loan note which will convert into another royalty. So we're trying to come up with a structure whereby the management's aligned with us. They're on their equity. They're big equity holders. They needed a significant amount of money relative to the value. So we're trying to keep everyone aligned and come up with a structure that works, and that's worked actually pretty well.
I think the market is now so much more creative that there's so much opportunity, I think, for companies to raise debt in different forms that it's great you're all available. We're running out of time. I should just ask the audience if there are any questions for the panel here. We've got a couple of minutes. If no questions, then I'm just going to ask you to take a punt on commodity prices. You asked me, David. So which ones are you backing and where are they going?
Do I need to go first? Yeah. I think some of the electric vehicle related commodities have had a very good run. I think typically we're running very long dated funds, 10 years or so. We're looking for things where there's pockets of value. We invested a number of years ago, for example, in uranium, which has done well. And we thought that was underpriced as a sort of commodity a few years ago. Quite like mineral sands as a commodity is interesting. And it has quite good fundamentals. I think gold actually is quite interesting. Market has come off somewhat, and inflation's clearly coming through in the system. I think that's quite interesting.
Do the IFC have to be agnostic on this sort of thing? Or?
Well, I always get my predictions wrong. So what we basically look is cost curve and all the other elements, because frankly, trying to guess what is going to do better than the rest is difficult. But I think similar to David, I mean, we're long-term investors. With in some assets we've stayed for 20 plus years. So we do look at sort of long-term fundamentals. We make sure that the asset can withstand the down cycles that will inevitably occur, and that the partners that we're with also understand the cyclicality and are deep pocketed. So what we've done lately, we've done mainly we've done copper, we're looking at lithium, we're doing manganese, we've obviously bauxite. I mean, we've gone pretty broad and wide.
Right. Well, we're just running out of time. So I guess your OCIM is gold, right?
Yes, gold and silver and platinum. Yeah, and that's our focus. Core metals trading business: gold, silver, and platinum. Yeah.
Denham.
We do not make predictions on the commodity price, but we're invested across many different metals and minerals.
Juan, any favorites?
Basically, what all they said. No, but we have a dedicated gold fund as well as the debenture fund, and the LPs into that fund are very much gold bugs. So we're believers in an uptick in the gold price as well. But the battery thematic is here for sure. So that the nickels, the coppers, the rare earths, I think still have probably maybe a bumpy ride in the short term, but on the over the longer term, pretty safe bets.
Excellent. Well, thank you all for your predictions and for your wise knowledge. Really appreciate it. Thank you, everyone.